The Federal Open Market Committee's minutes clearly show that members are preferring to taper this year itself. Tapering means lowering the amount of bonds that the Fed buys. Now, you can see the hawkishness in the comments in several places, that when it says economy has already reached the FOMC's inflation goal of 2%. Some of the members are also pointing out there is progress seen even in job growth. Again, very close to what the Fed wants. They're also pointing to upside risks to inflation. Some of the members have spoken about it, and they say that even if the inflation proves to be transitory, it will stay long for longer than the Fed members anticipate. Some are also worrying about elevated valuations of several asset classes. They point out that because of this high liquidity, prices are higher, both of assets and goods, and that can threaten financial stability. But there are some dovish points which we have to note. First of all, they say this lowering of asset purchases is provided the economy evolves as the FOMC is anticipating at this point in time. Now, employment, they say it has grown, but their quote is substantial progress. Further substantial progress, that benchmark has not been reached. They also point out to uncertainty in economic growth because of the Delta variant, and it's spreading fast in the US. Also, the most important dovish note they strike is there should be no link between the timing of lowering the tapering bond purchases and rate hikes. Don't confuse it with rate hikes. Now, reaction to the Fed's minutes have been widely divergent. All risk assets, that is equities and commodities, have fallen by about 2 to 4% over 2 days after the minutes were announced. But bond yields actually fell. Normally, bond prices should fall when the Fed is going to buy less. But actually, bond prices rose and the yields remained soft. Now, why is the bond market not afraid of tapering? Well, let us look at how much is the Fed buying. The Fed is at the moment buying 80 billion US treasuries every month and $40 billion of MBS. By MBS, you mean mortgage-backed securities every month. Now, as a result of all this buying, the Fed's balance sheet has increased from $4 trillion before COVID, that is last March, to $8.5 trillion today. Now, Fed members don't want this 8.5 million to lower. They are only saying that you lower the purchases, which means the balance sheet will still increase. They want Fed to buy 70 billion treasuries instead of 80 billion and 35 billion mortgage-backed securities instead of 40 billion now. So, reduce it every month. If they go that way, the Fed's balance sheet will continue to grow for the next 8 months after tapering starts. So, it's not as if the balance sheet or the amount of money coming into the bond markets is decreasing. And as if that is not enough for the bond market, other central banks like ECB have also increased their balance sheet from $5 trillion before COVID to $9.5 trillion now. So, that explains the happiness in why the bond markets are not worried that, central bankers are going to stop buying bonds. Now, there are also mixed views about the US macros itself or global macros. See, these are the hawkish points. Growth is good. Q1 GDP 6.3, Q2 GDP 6.5, and inflation definitely. Last 2 months it's at 5.4. Remember, pre-COVID they could not even get to 2%. Job growth again positive. See the last 3 months from 560,000, 845,000 to 943,000, they've been growing. But what the doves are saying, the dovish noises in the market, US is still 8 million jobs short of what it was at pre-COVID levels. Also, another dovish note, US retail sales, which just came, July retail sales number, they have declined by 1.1%, and they were expected to decline by only 0.3%. But let me put the counter. If you compare to before COVID, retail sales are still 17% higher, and therefore this very interesting note from Credit Suisse. They say retail sales in most categories are several standard deviations higher than pre-COVID. For example, grocery is about 10 standard deviations higher than what it was before COVID. And what they ask is, can that level of purchases continue? It can't sustain when normalization returns and people start going out to restaurants. Why will they buy so much groceries? And likewise, as people spend more on services, they will retail sales will come down. In fact, Credit Suisse points out that retail sales is coming down in US and in China. And that is why perhaps the bond markets are noticing that the best of growth is behind us and the worst of inflation also is probably behind us.